What if I told you that there's a way to qualify for investment property mortgages without using any of your personal income or tax returns? Yes, you heard that correctly. If you're a first-time investor or a seasoned investor, a DSCR loan could be your secret weapon and change the way you invest in real estate. Stick around. I'm going to tell you all about the program, the ins and outs of it, and how you can start using it immediately to get your next rental property or take advantage of rental properties you already own. So first of all, Jason Evans, I'm a mortgage loan officer. I work at Rate, and my NMLS number is 21205. Okay, so first of all, DSCR, what does that stand for? It stands for Debt Service Coverage Ratio, and it's a mortgage that is specifically for business purpose only, meaning you're going to be buying a property or you already own a property that is strictly rented out. You do not live in it yourself. So it's business purpose only as a rental. It can be on condominiums, single family homes, 2, 3, and 4 unit residential properties. So business purpose only for renting. 2, 3, 4 units, single family and condos are all good scenarios. So the way this works is we don't look at your personal income at all. So you could be self-employed, showing losses on your tax returns from your business. You could have no job. You could have a ton of money coming in from employment. It doesn't matter. We're going to look at just the cash flow of the property that you're financing. So whether you're purchasing a property or you already own it, we're going to take the rental income. I'll talk about where we get that number from in a minute. But we're going to take the rental income and divide it by your expenses for the home. So the expenses we're talking about here are your principal and interest on the mortgage, your property taxes, your homeowner's insurance, and the HOA fees if it's in an HOA. If there's flood insurance, we'll factor that in as well. If you're getting an interest-only loan, which yes, those are available for this as well, then we just factor in the interest only, and there's obviously no principal to factor in that case. So as long as that rental income, the gross rental income, exceeds those expenses I just mentioned, we'll approve you for the income portion of the loan just based on that. We don't look at any of your personal data as far as income goes. So it makes it way more streamlined to qualify. This is huge if you're self-employed and you don't show income, or you're unemployed, or you just don't want to deal with documenting all of your income because you have a few different things going on, or you own a ton of different properties. We only care about the property you're buying, or again, the property you're financing if you already own it. So that's huge. Now, some other key factors with this program. One, if you already own properties, you can have up to 20 finance properties with this program. So that's a lot. And that's just finance. You could own more than that, but 20 of them that are financed. We can add in a prepayment penalty which is state specific. Some states don't allow you to, but most states allow you to have a prepayment penalty on these types of loans for up to 5 years. By doing that, if it's going to be a buy and hold property for you, or a property you already own that you're going to own long term, having that 5-year prepayment penalty can greatly reduce the interest rate you're getting on a 30-year fixed mortgage. So it permanently reduces the rate. And in a lot of cases for my clients, they've actually ended up with an interest rate that's lower than what people would typically be getting on an owner-occupied property. So it's a huge savings there if you know you're going to hold on to this mortgage long term. Definitely something that we can go over with you. Other than that, some other key features with this program, you need 20% down, which actually on multifamily properties, conventional loans with Fannie Mae and Freddie Mac require more than that. They require 25% down. So with this, you can do 20% down, including on multifamily homes. You can have a credit score as low as 660. So a pretty low score. You can still use this program. We can do this for loan amounts up to $2.5 million. So $2.5 million is the max loan we can go to. Again, it's all based on the collateral as well, so the value has to support it, but we can go up to $2.5 million for a loan amount. A really cool feature is you can own these properties in an LLC. So it doesn't have to be in your personal name. A lot of people will get a loan in their personal name, and then after the closing, which is technically not even legal, they'll switch it into an LLC afterwards. We're okay with you owning the home in the LLC, and we'll close with you owning the home in the LLC. Yes, we'll review the LLC paperwork and make sure it's all compliant, but it is allowed. Most residential mortgages don't allow that, so that's a good feature as well. Here at Rate, we underwrite these loans with our underwriters, so we're not sending it out to a third party to underwrite it. We're handling it in-house, which keeps control in our hands and helps us to streamline the process, so it's a much easier way to get the thing done. We offer these loans you could have a 30-year fixed mortgage that's interest only, You could also have adjustable rate loans, either principal and interest or interest only. So lots of different options to choose from depending on your preference and your exact scenario. Some of the other things to know about this, we mentioned having the income, which is strictly based on the property. You don't need any personal income. You need to have at least a 660 credit score. We need to be able to document where you're getting the money from for the 20% down payment. In addition to the down payment, you need to have some financial reserves as well. It could be as little as 3 months worth of payments on the new property you're buying or the one you already own, but you do need to have some additional savings, which could even be retirement accounts as well. So you need to be financially have some reserves there. If you are doing a refinance on a property you already own, you can still use this program as well. And the cash out you're getting, if you're getting a cash out refinance, can go towards that reserve requirement. So there are ways you can work it that way as well if you already own the property and you're trying to get some cash back out of it. One important thing to know about this program is it's not available if you are a first-time home buyer. So a first-time home buyer by mortgage standards is defined as anyone that has not owned real estate in the US in the last 3 years. So if that's the case, you can't use this program to get a rental property. You need to already own a home or have owned a home in the last 3 years and have a primary housing expense. But if you already own and you're looking to get a rental property, this is a great option for you. It can be your first time getting a rental property. That's okay. You just can't be a first-time home buyer. Now, one key thing to talk about as well is where do we get the rental figure? Because so much in this program is based on the rent and making sure it covers those expenses that I mentioned, which again, principal, interest, taxes, insurance, flood insurance if it's in a flood zone, and HOA fees. So how do we determine if the rent's high enough to cover that? Where do we get the rent from? Well, if there are existing leases in place, we're gonna look at that and see how much that rental income is. We're then gonna compare it to what the appraiser tells us the market rent is based on comparable homes in that area that have been renting recently. So we're gonna use the lower of the two. If you have a really low market rent number, but a really high current rent with leases, the underwriter is gonna want to use the market rent from the appraisal, but with proper documentation and showing that those leases are legitimate and they are actually collecting that rent, we can still use the rent from the leases. If it's the other way around and the market rent on the appraisal is higher than the leases, we still have to use the leases in that case because that's the real life rent that's being collected. If the property's vacant, we're gonna go off what the appraiser determines is the market rent. Now, a lot of people are trying to buy homes to use for short-term rentals as well. We can use the short-term rental income if that's gonna be beneficial to you and that's how you're gonna use the property. Then we can have the appraiser do an analysis on the short-term rental potential for the property and use that number. Or if it's a home you already own and you're doing short-term rentals, we can get your history for that and go off of that short-term rental and not just what a 12-month lease would show for rental income. So you are able to take advantage of short-term rental numbers if that's gonna be more favorable for you and that's how you're gonna use the property or that's how you've been using it and we have the history to document for that. So lots of really cool features with it. Again, at its core, the most basic is you don't need to have a job. You don't need to have any income. You can get a rental property based on the cash flow of the property you're buying. It's a great opportunity for people to get involved, to buy more rental properties, and to qualify more easily. So awesome program. A lot of people don't know about it yet. I wanted to help get the word out. I'd love to talk to you more about it. I'm going to put up a map of all the states I'm licensed in. If you're looking to buy rentals in one of those states, I'd love to talk to you about it and help guide you through your options.